Hi, I'm Amy, and today I'm here to do an e-tutorial with you on exercise 9-3 from the Pearson textbook. You'll note that I put some instructions up on the top here in case you're having some trouble finding this exercise in your workbooks or on eConestoga. Okay, the way I like to start a question usually is to read the required. There's no point in reading the question without knowing what it is you're looking for. So we have two requireds for this question. The first one is to prepare some journal entries for the month of March. And the second is to prepare some T accounts for accounts receivable and allowance for doubtful accounts. Main purpose being to allow us to answer the question, how much does Big White expect to collect? Okay, so we're going to start with our journal entries for the month of March. So we'll go back up to the question now and read what information they give us about the transactions that happened during the month of March. Okay, so on February 28th, they had a balance in their accounts receivables. We know we're going to need that for part 2. We don't need it for the journal entries for part 1. During March, the company had sales of $65,000, which included $60,000 in credit sales. Okay, what we're going to do is color code some of this information so that when we go to do our journal entries, we have a sense of how many we need to do first of all. So we definitely are going to have to record our sales. We also had collections during the month of March of $53,000. So we'll be wanting to record those as well. We wrote off some uncollectible receivables. And the other data they've given us here, February 28th balance for allowance for doubtful accounts. Again, we're going to need that for part 2, but we don't need it for our March journal entries. And then bad debt expense is estimated at 3% of sales. So this here is something that we are going to have to calculate for a journal entry for March. Okay, so we've got 1, 2, 3, 4 journal entries to do for the month of March. So let's start with our blue one. The company had sales of $65,000, which included $60,000 in credit sales. So the difference between these two numbers is going to represent cash sales. So when we make a sale for cash and cash comes in, cash goes up on the debit side of things. So let's first record cash. Okay, so cash is going to be a debit, and that debit is going to be the difference between our total sales and the sales that were made on credit. Credit sales, for those of you that forget the terminology, when we make a sale on credit or we have something called credit sales, what that means is we've made a sale to a customer, but the customer has not yet paid us for the merchandise or the service that we've sold to them. That results in an accounts receivable. Okay, so we now have a cash sales of $5,500. We have accounts receivable or credit sales in the amount of $60,000, and the offsetting credit to this then is sales revenue for the full amount, $65,500. So that takes care of our first journal entry. The second journal entry we have up here in purple were collections of $53,000. Collections implies that your customers that did owe you money have now paid you. So the first thing that we want to record is the cash being received from these customers. So our cash is going up again on the debit side, so we're going to debit cash for $53,000, and these customers no longer owe us money, so we want to reduce the receivable. Receivables are normally debit, so to reduce it, we're reducing it on the credit side, giving us a credit for $53,000 for accounts receivable. The third one up here, write-offs of uncollectible receivables totaled $1,250. When we write off uncollectible receivables, it's a little bit different than setting up an allowance for doubtful accounts. What we're going to do with our fourth journal entry is estimate how many accounts may not get collected. What we're doing when we're writing off uncollectibles is we are saying, remember that we said we might not collect this money? Well, now we're really pretty sure that we're not going to. And so what we want to do for those customers that we've identified as customers that are not going to pay us is we want to remove them from our accounts receivable subledger. So in order to do that, we want to pull them out as a credit, and the offsetting account is going to be allowance for doubtful accounts. Okay, what you can see here that I've written off at the side, allowance for doubtful accounts is a contra asset account to our accounts receivable asset account. So by debiting one and crediting the other, I'm actually making no impact overall to the net accounts receivable. I'm just cleaning up my books to take out the customers that are no longer, I guess, going to pay me. I don't see them as a viable source of money anymore, of cash anymore. So we remove them from the receivables subledger and we lower our allowance for doubtful accounts as an offset. Okay, our fourth and final entry for March comes from the extra information given, which was bad debt expense is estimated at 3% of credit sales. Okay, so for this one, we're going to calculate 3% of credit sales. Our credit sales was given as 60,000. So 3% of 60,000 is 1,800. That ends up being our estimate on what we're not going to collect using the percent of sales method. So we debit our bad debt expense, which is an income statement account, and we credit our contra asset account, allowance for doubtful accounts. I've made a little note for you off to the side here. When you use percent of sales under the allowance method to determine allowance for doubtful accounts, we ignore the initial balance in the allowance for doubtful accounts account. So as you were working through your DSMs in Pearson, you may have noted that sometimes we do include the initial balance in accounts or allowance for doubtful accounts, and sometimes we don't. When we're using percent of accounts receivable, for example, we care what's in the allowance for doubtful accounts initially. However, when we use percent of sales, we don't. We just do a straight calculation. 3% times the 60,000 gives us our entry. So again, that little note there you can make for yourself in your study notes. When we're using percent of sales to determine allowance for doubtful accounts, we ignore the initial balance in the allowance for doubtful accounts account. Okay, so that takes care of our first requirement, which was the journal entries. Requirement number 2 is asking us to prepare T accounts to show the ending balances in allowance for doubtful accounts and the accounts receivable. So remember, both of these accounts are balance sheet accounts, which means they're permanent, which means we don't start from zero the way we do with our income statement accounts. So going back up to our given information, this is where the February 28th amounts come into play. Okay, so February 28th, we had a debit balance in our accounts receivable. Okay, and also on February 28th, then we had a credit balance in our allowance for doubtful accounts. So looking at our T accounts then, I want to put those balances in. Okay, our February debit balance of $25,500 and our February credit balance of $1,300. From here, we're going to go to the journal entries we created in requirement number 1, and we're going to look to see where we debited or credited these two accounts. So we're going to our first entry up here. We see accounts receivable with a debit balance of $60,000. Okay, going on, the second journal entry has accounts receivable again with a credit balance for collections of $53,000. And then our third journal entry, we saw that write-off of $1,250. So that's all the transactions affecting accounts receivable. So what we're going to do then is total them up. We're going to have a net debit in our accounts receivable, which is good because accounts receivable does normally have a debit balance. And so when we add up our debits and take away our credits, we end up with a balance at March 31st of $31,250. We do the same thing over here with the allowance for doubtful accounts. The first time we see that account is right here with our write-off. So with the write-off, we end up debiting accounts receivable for $1,250. And then when we use our percentage of sales in our final entry, we end up with a credit of $1,800. Do the same thing. We're going to add up our credits, take away our debits, giving us a net debit amount or credit amount at March 31st of $1,850. So we've done the first thing. We've prepared T accounts showing ending balances in accounts receivable and allowance for doubtful accounts. The next thing is compute the net accounts receivable at March 31st. So net accounts receivable is the accounts receivable balance minus the allowance for doubtful accounts. So we're basically taking these two accounts and adding them together because we have a debit here and a credit here. So we'll fill that in. Net accounts receivable is our $31,250 minus our $1,850, giving us net accounts receivable or net receivables of $29,400. So the question that says, how much does Big White expect to collect? This is the answer. The answer is the net accounts receivable or the net realizable value of accounts receivable, which is $29,400. And with that, we have completed the requirements. So you can go back again and go through this fast, slow, pause it as you need to, but I hope that makes some sense. Thank you.